Welcome to Industry Focus. I'm Nick Sciple. Joining me today is Motley Fool analyst Buck Hartzell. Our special guest is Lawrence Cunningham. Professor Cunningham is the author of 24 books, with his latest book being Quality Shareholders, How the Best Managers Attract and Keep Them. In addition to his writing, he serves as a faculty member at the George Washington University School of Law, as well as consulting on corporate governance, and serving on the boards of directors of numerous public and private companies, including Constellation Software, where he currently serves as vice chairman. Lawrence Cunningham, welcome to Industry Focus.
Wonderful to be here.
Thanks for joining us, Larry. We appreciate you taking the time.
Always a pleasure to be with you, Buck, and the Motley Fool crowd.
Yeah.
Yeah, Larry, you mentioned your writing. You've been writing about Warren Buffett and compiling his letters for a number of years. He just turned 90 over the weekend. You know him personally. Just kind of a fun question off the bat. What birthday present do you buy for a guy like Warren Buffett, a guy who has everything?
An A share. I'm just kidding. He's trying to get rid of his A shares, but I think he appreciates substance. So I'd send him a book, and I think just a little note about the legacy of intelligent investing that he's handing down. That is it's widely followed. Probably still not by enough people, but I think that's probably the thing that's been most important to him is that he's provided education for people. I think that's the thing that's nearest and dearest to his heart. I mean, other people think he's a great investor, a great manager, a great philanthropist. I think all those things are true, but I think he's probably most proud really of having been an educator. And so I'd give him a book and just remind him of the legacy he's created.
That sounds like a great idea. I might get him a PowerPoint person to help him out with the next annual meeting. It's clear when he put those PowerPoints together by himself.
Those slides were great. But my favorite one was, I think it was an estimate of the national debt in 1812 or something like that. It said, estimate W. Buffett.
Yes, exactly.
As the source.
had to get the source in there for sure. Oh, that's great. So let's talk a little bit about, there's been some great things that are going on at Berkshire Hathaway and some changes that have gone on. I guess the most recent one is he's around his 90th birthday, he announced the deal. He's invested in Japan. So he's got kind of a basket approach going into a bunch of these kairetsus in Japan. Any thoughts on that investment? We know, he said in his release that he borrowed some money in Japanese currency there at about 1%. If you look at across those stocks, they're yielding about 5% or so, 4 to 6%. What do you think? What got him interested? Is this classic Buffett looking at an out of favor sector, or is there something other we should read into this with inflation?
The thing that jumped out at me is Berkshire historically has focused almost exclusively on the United States. Some exceptions in Germany in the insurance sector, exception for an Israeli manufacturing business. They bought a small German motorcycle supply business 5 or 7 years ago. And obviously the subsidiaries tend to operate globally. But this is really the first significant investment that Omaha that is Warren's portfolio has done outside the United States. That's what struck me as most significant about it. And Warren has always attributed that domestic bias to his circle of competence, saying, look, I don't know enough about the economic context of European or Asian businesses or the governance systems. And so I thought it was a remarkable pivot or signal that he's become comfortable. He's learned about a different business culture. And I have to say, the Japanese business culture is radically different from the North American culture. As you said, the 5 companies are all members of kairetsus, these complex conglomerates with interlocking ownership. The culture of business in Japan itself, it's a very inward-looking, very domestic kind of culture. So he's obviously saying, he's not violating his circle of competence. He's signaling that he's learned a lot about that economy, that culture, this set of businesses. And so I think that's quite important about it. But obviously, your points about there being value here and being able to even leverage a little bit is interesting. And I get the feeling these are Warren's moves. Many of his recent moves have been attributed to Todd Coombs and Ted Weschler, especially the Apple position. But it sounded to me, and they're not always entirely clear about who's making what decisions, but it sounded in this release that this is something that he has been involved with and thought about. So I think that's, and there's much more to say, but about that aspect of it, that, Berkshire goes abroad or goes to Asia. And that's bold, I think.
It is something that I don't think most of us that follow Berkshire would have suspected. If you had us write down 5 or 6 stocks that Warren Buffett was buying, after COVID or even before and during, we probably wouldn't have picked Japanese companies. So it's great. 90 years old, he's still surprising us, and I'm sure it'll turn out to be a pretty good value. He knows a thing or two about investing in financial companies. So yeah, it should turn out okay. I want to ask you quickly, Bill Ackman is a guy who's a well-known investor, kind of a swing for the fences guy. He had a big stake in Berkshire Hathaway, but only briefly, and he sold out of it pretty quickly. You wrote an essay about that, and maybe it ties in well with the book that you're coming out this fall, but what are your thoughts on Bill Ackman selling out of his Berkshire Hathaway stake? And was Warren really crying at home when he heard that Bill Ackman had left the fold?
Well, I should first say that I know Bill and like him. I've known him for a long time. He was one of the he was present at the symposium that I did with Warren on his letters 25 years ago. So okay. I admire him, and I think he's he and his brand of investing can play a useful role in promoting managerial accountability and so on. So my comments on his position in Berkshire are not personal at all. But I do think that as a style, it's not the Berkshire style of investing, either the kind of shareholders Berkshire wants to attract or the kind of shareholder Berkshire wants to be. Berkshire wants to attract and wants to be a long-term committed shareholder. That is one that loads up, that it doesn't diversify widely, but focuses on individual companies. Berkshire's gotten pretty diverse in its portfolio just because of the amount of money it has, but it's still pretty concentrated in, its huge bets on 6 or 7 companies. And that kind of conviction is something Warren has always practiced and always wanted in his shareholder base. He brags a lot about how concentrated his largest Berkshire shareholders are. That is, the Berkshire holdings are their largest position by far compared to the second or third. And very many of those shareholders have owned Berkshire for 10, 20, or 30 years. So that's the kind of shareholder he wants. That's the kind of Berkshire Buffett want. That's the kind of shareholder he's always been. And you're right, I call that the quality shareholder, to distinguish both from the indexers who may be long-term but are totally diversified on the one hand, the short-termers who may load up but never stick around. And Bill, in this case, will very often be in that latter category. Now he's doing something else. He's usually trying an activist position and trying to nudge management, push management in new directions. So he's adding a different kind of value. But I knew Bill was a Berkshire shareholder. I've seen him at the meetings and everything. But Bill is not the typical, the quintessential Berkshire shareholder. So the fact that he sells out, no offense to Bill, but I think that increased the average quality of the shareholder base rather than decreased it. So I considered it positive for Berkshire.
Okay, yeah. And one thing, you mentioned kind of long-term shareholders, and there's certainly people that have owned Berkshire for decades, 3-4 decades or more. But the people that are kind of relatively new, I'm saying in the last decade or so, Berkshire hasn't performed that well, certainly relative to the S&P 500. And I think for those of us who follow it pretty closely, the S&P 500's been on a tear. It's been technology stocks have done unbelievably well. You mentioned Apple, probably the single biggest investment gain on one stock, I think probably in the history of the world. I mean, he's probably up $85-90 billion on one stock position. Pretty good for an 89-year-old, I guess, at the time, or 88 when he made the deal. But what are your thoughts on those long-term shareholders that haven't been there for 40 years, but they've been there the last decade and have seen relative underperformance? Do you think that changes going over the next 5 years or 10 years? How do you think about that?
Well, flash has never really been Berkshire's strong suit. You know, Buffett is a very folksy, conservative guy. You know, very little leverage, very little shuffling of assets. You know, just a permanent, quality-oriented guy looking for well-run businesses. You know, he's never looked for the stratospheric returns. He's always wanted a modest return. And you're right, the earlier decades were the best for Berkshire, and they've just steadily gone to average or close. And part of that's a matter of size. It's just much more difficult when you're investing hundreds of billions of dollars to outperform. Nevertheless, it's been a solid run. You know, I think you sleep well at night that decade. You certainly earned the S&P or a little better without much risk. And so it remains, I think, rewarding for that cohort. As for the next 5 or 10 years, we can be almost certain that the company will change significantly, because Warren will almost certainly leave the scene, whether because he'll step back or worse. And so you'll have a succession, and we'll get to witness the effectiveness of the succession plan, which is a very elaborate plan. I think it's the best possible plan they could have. You'll have Greg Abel probably take over as CEO, who's overseeing all the other CEOs in the operating companies. Todd and Ted taking over as CIO, managing a portfolio and making equity investments. Howard Buffett will become chairman of the board as a steward of the traditional cultural features of Berkshire, like permanence, autonomy, and trust. And then in the shareholder piece, you'll see a gradual sale of Warren's holdings over a period of about 12 years, where his estate will transfer about 5% of his shares to the Bill and Melinda Gates Foundation, which will then be required to liquidate it and make gifts. So over a 12-year period, you'll see the company go from having a controlling shareholder to not having a controlling shareholder. So all of that, by design, gives that team, Greg, Todd, Ted, and Howard, and everybody else, a little bit of a runway, a little bit of time to prove that they can manage Berkshire to those values, and with at least the solid returns, the reasonable returns that have been achieved in the last 10 years. And maybe they'll do better. Greg is a savvy investor, a savvy manager. He's done a very good job investing capital at the energy companies for 20 years. You know, one of Berkshire's biggest acquisitions in the past several years was the recent one at Dominion. That's Greg's baby. He's trained excellent successors at the energy company, some of whom have moved around within Berkshire. The CEO of See's Candies, appointed a year or two ago as a former Greg protege. So I think I have a lot of confidence in Greg, but that's where the proof will be. Can Greg, and obviously Ted and Todd have to help deliver too, but that leadership, I think, is mostly going to be coming from Greg. Can he do it? I have confidence that he will, and I think that structure will give him the time. If he has a bad first year, I think he'll get the benefit of the doubt, but he will have to deliver over 5 or 7, or else you'll start to see some of those quality shareholders drift away, and some of the activists, maybe even Bill, start creeping in. So I'm bullish. I'm optimistic on Greg and on Berkshire, on the value of this special culture Warren's built up. But obviously, I need a crystal ball that none of us have.
Yeah, I think those of us that follow along, and I'm glad, Greg was involved in this year's annual meeting, and both him and Ajit in the previous ones a little bit, those guys being promoted to vice chairman and giving them some face time with shareholders, I think is really important at this level. Was happy to see it. I think one of the headlines that's out there a lot is Buffett's holding so much cash with whatever, 128, 130 billion or whatever else. When you look at it historically, though, as a percentage of assets and in some other ways, it's not really out of line with the amount of cash that Berkshire's held. It's just the business has grown in size. I doubt, though, that the successors will get that pass. I think there's probably going to be a little bit more pressure on them. Do you see Berkshire ever paying a dividend while Buffett's in charge, or do you even see them doing it after he's gone?
Almost certainly not while Warren is in charge, and that's been part of the cultural motif of the company, partly because shareholders are almost all tax-paying shareholders, and so there is not a strong appetite among the quality shareholder base for a dividend. In fact, Warren polled the shareholders twice, once in the mid-90s, I think it was, once in around 2012 or so, saying, I don't think we ought to distribute cash dividends, but what do you think? And he got overwhelming support for opposing the dividends. So I don't think there's a strong appetite. There are obviously some people or some shareholders and activists may like that kind of liquidity, but most of the holders don't have the appetite, and it's not been part of Berkshire's culture. And Warren has kept that powder, kept it dry, and found uses for a lot of it. And I think Greg will do the same. And you're right, as in terms of the relative scale, it's not wildly high. And the other footnote I'd add is that Berkshire has always said that it maintains a significant cash balance to assure having liquidity to meet significant insurance claims if catastrophe strikes. In the past bunch of years, that number has been 20 billion. And the signals I got from his presentation at the annual meeting is that in light of COVID and potential second order effects that we still haven't seen, that number might need to be higher. So I think it certainly in the near term under Warren's tenure, I wouldn't expect a dividend out of Berkshire. I do expect, and you do see, increasing share buybacks.
Yeah, I've seen that. Yeah, finally, and I think people have I think that was one of the things Ackman anticipated that was going to happen when the share price was below $300,000. And it really didn't happen to any big degree last year, but we've seen a little bit of a pickup with that, and it seems to be around 1.2 times book value or so. Which seems to be the area that there's a little bit of interest there in buying back shares. Why do you think he loves investing in companies like Apple, even IBM prior to that buy back lots of their stock, yet he's been reticent to do it at Berkshire Hathaway. Even Washington Post, when he directed the buybacks there, had a lot of value, back in the 70s. Why do you think? Is it part of the partnership trust thing? Is that the reason he hasn't bought them back? Because he clearly likes investing in companies that do that.
Yeah, that's what he's always said, that he's conflicted about buybacks as a strategy at Berkshire, because if it's an attractive investment for Berkshire, so the price is below value, that means the sellers on the other side are not getting that kind of great deal. So he's got some conflict around that partnership aspect of his view of the holders. On the other hand, his remedy for that is disclosure, is clarity, and appreciates that there are times when even quality shareholders, as I call them, have to sell. Estate planning, death in the family, generational problems, health problems. And so I would say I think he ends up being prepared to do it as long as fair disclosure has been made. But I think it is important to notice, as you just did, that this in 2020 the level is significantly higher than in all of the past several years combined. So I think that's notable as a part of Berkshire's internal capital allocation.
Yeah, it'll be interesting to see what happens, and the price has gone up too since then. Since it was below $300,000. So quality shareholders, I want to ask about that one more time, just make sure that people listening at home going to understand. How do you define a quality shareholder? We know it's people for the long term. Do you look at the turnover in the stock, the annual turnover? What's a way that somebody at home that's looking from the outside can say, I'm looking at this company, but I want to know if they have a quality shareholder base or not?
Yeah, excellent question, Buck. And so I drew a matrix, a sort of a 2x2, and looked at conviction and duration. And so conviction, I'm looking for high conviction, high duration. And so conviction is measured by the relative concentration of a portfolio, an investor's portfolio.
Yeah.
A concentration of at one extreme would be 0, where it's fully diversified. An index fund like Vanguard or State Street or Northern Trust or something like that. At the other extreme, concentration of close to 1 would be only one stock. Hardly anybody does that, but a lot of firms and funds own 20, 30, or 40, and that's a fairly highly concentrated position. And when you look at who does that, so I did empirical research to identify which shareholders do that. This is based on public filing, so I don't have for individual human beings, but and you see Neuberger, Berman, Capital World, Franklin, Fidelity, and some mostly smaller firms, 100 to 300 billion assets under management. But so those are, I call it high conviction shareholders. They do a lot of research, they study, they understand, they may even participate a little bit behind the scenes in shaping management. The other quadrant in there is duration. And here I look at average holding periods, turnover of the portfolio, a number of different metrics to try to identify which of those firms tend to have the longest horizon, the most patience, the greatest patience. And again, you see there are lots of firms that are momentum traders and day traders, arbitragers, whose average holding period is extremely short, months, maybe a year, and others that are more than 4, 5, or 7. Doesn't get much longer than that most of the time. And these may have large positions. They may buy and sell big blocks, but over short periods of time. So I'm looking at the shareholder base that does both of those, high conviction, high concentration. So it's not the indexers, it's not the momentum guys, and I leave the activists out to one side. And so I identify who those firms are, and I discuss a little bit about their investment philosophy. And then I turn around and I look which companies attract that sort of shareholder in highest density. And so again, I run a huge series of empirical tests around the Russell 3000 basically, and then had 2,200 companies that I ranked in order of quality shareholder density. And Berkshire's way up there at the top. You'll see the listing in the book. I don't publish the whole thing because I don't want to make any of these companies sticky. I'd like to see them try to be more nimble, and also just as a matter of the data that obviously it changes day to day. So I don't want to put it in a black box, but I identify a lot of them, and then I try to figure out what is it about these companies that attract this cohort. And some of it's most of it's unsurprising. They tend not to do quarterly forecasts. They tend not to do quarterly conference calls. They tend to have very high quality annual meetings, annual shareholder letters. They talk a lot about capital allocation. They themselves emphasize the long term in their strategy, in their discussion, in their accounting measurements, and on and on. We've got a lot of different. So that's the method, and that's what I try to reveal. For us sitting at home, the Motley Fool constituents, I've done it. I mean, I did a pretty heavy lift. There's a lot of data in this, and I had experts, PhDs crunch the data. But you can identify which are the highest quality shareholders with a little bit of poor man's research, and then you can identify in which companies do they tend to invest, just as an additional filter. And then you think harder about, well, why Danaher, why Markel, why Graham Holdings, and then just add that to your analysis. You still have to do the fundamental analysis. Yeah. But that's, I think, an underappreciated feature in investing. I think people have an intuitive sense that, and let me just add one thing. So the other question is performance, and we crunch the data again and see that the evidence supports the idea that a quality shareholder strategy can systematically outperform, and that a portfolio comprised of the top, high density attractors outperforms. So not every company, not every fund, but it's not a bad tool to add to your investor toolkit. And again, the intuition is, it ought to be the case that the quality of the shareholder matters to the performance of a company. There's got to be some influence. If you got a bunch of short-term traders as a manager, you're going to be catering to those short-term traders. So you're going to miss out on a lot of long-term strategic initiatives and so on. But if you've got patient, convicted, high conviction shareholders, you've got a runway and you can execute on those strategies. So I think there's a lot of intuition around this idea. And what we've done is really try to put as much data behind it as we can, and then explain it.
Yeah, that's great. And I think one of the things at the Fool that we've seen over the years is that most people, there's a lot of false dichotomies out there. And one of those is that people thought if you invest in tech, you need to turn over and switch in and out of shares a lot more because there's disruption and things happen. And what we've actually seen, and as David Gardner is really the kind of pioneer for this at the Motley Fool, is he's done the exact opposite of that. He's found really great companies led by people that think in decades, like Jeff Bezos and Amazon, and he's held them for the long term. And it's crazy to me, but we see this from people all the time. They have a stock that does well. It goes up 20%, 30%, or 50%. They're like, I've got to sell this. We're like, what? You don't want to sell out of what's doing really well. If it's led by great people and the company is executing on that, let them roll. You know what I mean? And if they happen to stumble or if something happens temporarily, go ahead and add to that position. You know what I mean? And it's a hard thing innately for investors to do, is to hold on to their winners. They kind of want to sell them off to lock in those gains. But
I think Dave does deserve a lot of credit for that. That it takes a lot of discipline what he's done, and I think he's been proven out. He's been vindicated by the strategy. And I think you mentioned Jeff Bezos. I think Amazon and Jeff in particular exemplify what quality shareholders are looking for. And Amazon has attracted them in high density, and you can see why. I mean, Jeff has always talked about that day one thinking. His 1997 letter to shareholders just hit everybody over the head about this is going to be a long-term play, and it took a long time.
Yeah.
But if you stuck with it, I mean, it's an extraordinary set of returns, and it's more to come.
Yeah, and it's just, you don't hear that often from the tech area as well either. I want to make sure that Nick gets some questions in here as well. I want to ask one more quick question though. Tesla and Apple split their stock recently. We know Warren has talked about stock splits. We've talked about them a lot to people. It doesn't really make that much of a difference. What are your thoughts on, does that help them attract quality shareholders or the opposite kind?
It has the opposite effect. Buck, you're right. That one of the research elements we did for the book, that when we try to figure out what are the things that companies do to attract long-term convinced high concentrated shareholders, is avoid splitting the stock. And it's, I think, pretty obvious to see why. The reason Apple and Tesla are splitting the stock, the boards of the company have said, is to attract new investors. But what that's going to do is going to attract a lot of short-term investors. It's going to induce sales by some, purchases by others, and then continued volatility and churn. And we flipped it around. If you look at the stocks of companies with the highest share prices, Berkshire is obviously in a class by itself with 6 figures, but they're only about 10. They're about 10 or 15 last time I looked that have 4-figure stock prices, including Apple, Amazon, Alphabet, and then some others that are less well known but equally important. They have very high quality shareholder bases, and it's because it's harder to sell for.
Right.
And the other signal it sends is that we're not focused on the stock price here. We're focused on running the business and generating high returns on invested capital. If the stock price is a little high, a little low, or gets way out of sight one way or the other, it doesn't really it doesn't influence our strategic thinking day to day. And so I'd rather have a board of directors thinking about capital allocation. Should we make this acquisition? Should we make this share buyback? Than thinking, what if we had the stock price about a fifth less, or half off? So right. I think it's a bad idea for both Apple and Tesla. Certainly in terms of quality shareholders. Yeah. They may not care. They may have priorities. Like someone said, Apple is trying to use a low stock price to attract customer loyalty and affection. Maybe that's right, but it's not how I think about it. So from a quality shareholder perspective, the quality of their shareholder base will decline as a result of the splits.
Yeah.
That's what all the evidence suggests.
So I want to link this quality shareholder concept with what we talked about earlier when it comes to succession. At Berkshire, you talked about Amazon's ability to recruit quality shareholders, how important Bezos's annual letter is to that messaging to shareholders. How significant is the presence of a founder leader at a company when it comes to recruiting quality shareholders? And how do the companies that have been able to maintain quality shareholder bases through a succession cycle, what do they do? How are they able to achieve that?
Oh, that's an excellent question, and the inventory there is mixed. We did not find a strong correlation with a sort of distinctive founder and high quality shareholders, and that's, I think, when you look at individuals, some are more trustworthy than others, some have a longer term horizon than others. They tend to attract, to use an old phrase, the shareholders they deserve, and so those who are long-term thinkers and strategists do tend to attract, and I think their presence and their personality matters. Jeff is a good example. Mark Leonard at Constellation is an example. Don Graham at Graham Holdings, or formerly the Washington Post, is a good example. Tom Gaynor at Markel. So there's certainly that. I could list another group of CEOs that are in some ways luminaries and founders and so on, but they haven't exhibited a similar disposition. And it's not criticism. They just have a different approach, a different outlook. They're not interested in the long term necessarily, and they're not interested in attracting any particular sort of shareholder. On transitions, it's also a very interesting story. I highlight two in the book. One of them I already mentioned is Graham Holdings. It used to be the Washington Post. That business struggled mightily as print gave way to the internet, and it spun off a cable operation, and it really morphed into quite a different business. And then Don Graham stepped down as chairman and CEO and handed the reins over to his son-in-law. A huge change in what the company is and who the leaders were. But what happened is, and what happened to the shareholder base, it was an extremely high quality shareholder base, including Berkshire Hathaway and a lot of followers of Warren in that tradition. As this transition got underway, that broke up, and those quality shareholders started to leave, and you can see it in the stock list year to year. But they've actually figured out they're gradually coming back as well. So they've managed through the transition, I think, relatively successfully. Another example is Leucadia National, Ian Cummings and Joe Steinberg's company that they built up over a period of 30 plus years, applying traditional value investing principles, a little different than Buffett's, a little more opportunistic, a little more of the old-fashioned cigar butt. They'd sell businesses relatively quickly, but they were authentic investors who explained their position, who understood capital allocation and educated their investors using excellent communications, especially an excellent shareholder letter. And they attracted a high density of quality shareholders. Now they got to the end of their run about 5 or so years ago. They engineered a very interesting succession plan through which they essentially sold themselves to Jefferies, the New York-based investment bank. Very different kind of business. And what you saw after that transition was a disruption in the quality shareholder base. You saw a lot of quality shareholders stick with it, I think, saying, look, if that's what Joe and Ian think, and not just blind faith, but Joe and Ian explain the rationale why Jefferies is attractive, why its leadership understood Leucadia, and why you can count on continuity around some of their rationale, the rationality of their capital allocation, and so on. So a bunch of quality shareholders stuck with them, but others left. And in the same way with Graham Holdings, I think that the merger, the sale has I don't think it's proven out completely, but it's a lot better than a lot of people thought. And so you see somewhat of a migration back in. So those are, I think, fascinating stories, and I explore some others in the book around successions at Progressive Insurance and some others. But Nick, I think it's a profoundly important question. I think that the leadership is certainly a big part of attracting long-term high concentration shareholders. And when that changes, people get worried. And that's going to happen to Berkshire Hathaway. I remain confident that transition will be a little easier than either Graham or Leucadia, and it will it'll prove out. But they're quality shareholders are not stupid, and they're not religious. I mean,
yeah.
So, if this is not going to continue to be a worthy company, they will sell.
Yeah, and Leucadia and Jeffries has struggled. I mean, from a business performance wise, they haven't grown book value in a long time. Rich Handler and Group are running that, but it's different because it's mostly an investment bank, and they've sold off and monetized most of the pieces that Joe and Ian had put together. Now it's kind of a pure investment bank. So yeah, Nick, go ahead.
Yeah, I guess one other question I had, just looking forward into the future, how companies recruit quality shareholders. Historically, it's been the shareholder letter, all that sort of thing, the annual report. Do you think we're in this 21st century? We've seen Tesla and other companies say we're going to use Twitter for official announcements about our company. Do you think companies should or should change the way they communicate to try to recruit shareholders in the year 2020?
Yeah, and Twitter or social media may be part of that in terms of the immediate outreach. I think some discretion needs to be exercised around that, because you simply get the rapid news cycle. I mean, all the research that I did and that others have done that I read indicate that the more frequently a company is producing information, press releases, 8Ks, the periodic, the quick updates, the more volatile the stock price is, the less long-term the shareholder base tends to be, which just makes a lot of sense. I mean, there are a bunch of traders out there who are acting on new information. So the more of it there is, the more likely you have high churn in your stock. So I'd be careful using a lot of Twitter. On the other hand, I think we all do need to migrate to platforms and digital. Obviously, in 2020, in 2020, we had essentially in North America, essentially no live annual meetings of shareholders. Almost everything was done with virtual platforms. And before 2020, you had maybe 50 or 80 big companies a year beginning to experiment with that. Intel did it, Duke Energy did it. I think the results of the experimenters were not bad. A lot of critics said you can't replicate the in-person feeling, the opportunity to shake hands and look people in the eye and ask follow-up questions and have breakouts and so on. You can't do that online. And that was a valid criticism. I think I even made it. On the other hand, it has some advantages. More shareholders can attend. The information tends to be deliverable in a much more efficient and consolidated manner. And if the technology permits interaction, I mean, it's really up to the CEO about how many follow-ups and so on that she lets them have. So I think pre-2020, the sort of assessment was mixed. But after 2020, a lot of the meetings were exemplary. I participated in a few where it was an excellent meeting. So I do think how fast we recover from this pandemic and what restorations we do, I think the digital meeting, the virtual meeting is here to stay. And the best CEOs who are interested in cultivating a quality shareholder base ought to become really good at that and entice long-term committed shareholders on that basis and reach out to them. So I think someone mentioned I was on the board of Constellation. We had a virtual annual meeting. We usually have 400 shareholders attended in Toronto every year. Digitally, we had 600. I helped chair the meeting around handling the Q&A, and I thought we got as many or better questions than we've ever had. And I sort of chaired the panel in effect, and we pushed back. I and two other analysts. And I think it was a very good conversation. And in any event, we got a lot of positive feedback from the shareholders. So even if we meet live next year, I think we'll add at a virtual piece. But Nick, I think you're absolutely right that it will pay for corporate leadership to embrace and shape how we use this technology.
The Constellations meeting was great, and the way you grouped the questions, the way it involved all the managers answering questions, I would make a strong call for Berkshire to do that. Maybe you'd be willing to organize questions for them by topic, because I think some of the way they're doing it right now, it's better than it was prior. You don't get all the questions, how do I become a good investor and things like that from somebody's kid that they're holding up there. But the questions that Constellation got were great, and I think there's some important questions that need to be asked at Berkshire, and it would be nice to do a similar thing. And I think maybe that's something they'll consider going forward, because that was great at Constellation the way that worked. So I have 2 questions left, and then I'll let Nick do whatever he wants. But one of those, you just mentioned Constellation. Mark Leonard's a great CEO. For those of the people listening that have never heard of Constellation Software, it's the best company you've never heard of because it's Canadian. It is a technology company, and it's been a wonderful performer. And so it's a great business. Mark Leonard's the chairman there, I guess. And I want to ask you, Larry, since you know both of them very well, can you compare and contrast Mark Leonard to Warren Buffett, and maybe what are 1 or 2 things they have in common, and 1 or 2 things that make them different as leaders of great businesses?
Thanks, Buck. Yeah, I admire them both immensely, and for some of the similar reasons. I'd say in terms of the 1 or 2 things they have in common, the greatest thing that distinguishes them from others and that they have in common is a very high degree of rationality. They are is more in command of their kind of emotional responses to things than anybody I know. I mean, they get happy and sad and joyous and remorseful and stuff. I mean, they're human beings, but they're able to control that aspect of their thinking and to really rivet on the substance of what's in front of them, like no one else I know or have read about. So they're very much up in the top. And the rest of us can learn from that. It's very important to discipline yourself around that, to be a human being and feel emotions, but at the same time to bracket them when you're making especially a business or capital allocation decision. And the second thing is I'd say that I'll call it absorption. They are just very good at digesting enormous amounts of information. Yeah. And that can be from reading, which they both love to do voraciously, conversations, lectures. Mark is way into digital information platforms and stuff, and so they're just very well read and well rounded, and it's just a capacity to digest information and synthesize it. So I could go down because I think that, I mean, the other big thing, I'll name a third. The other thing they have in common that may be most relevant for us is that they think about their companies and their acquisitions, their investments, and almost every other decision that happens at their companies in terms of capital allocation. It's their North Star. They're always in business. Really what you do with every dollar is important, and that's how they think. And not every CEO does that. These guys are both trained in the investment world. Warren in the old-fashioned kind of merchant acquisition investment. Mark more in private equity. But on the opposite side, on the things where they're different, their personalities are quite different. Warren has always been a little bit of a showman. He's an all shucks kind of guy, modest, Midwestern, and so on. But he's welcomed the limelight. He is very happy to be on television. I don't think he has, he's attracted the tens of thousands with enormous festivities and really a conscious commitment to having a spectacle out of, he even calls it the Berkshire, the Woodstock of capitalism and all that. I think Warren actually is not that he's eager for it, but he's quite okay with the extensive coverage on television and now the internet and books and so on. Mark is exactly the opposite. wasn't just until a couple of years ago, there was not a photograph of Mark Leonard available on the internet. You couldn't find out what he looked like. These days, it's impossible to prevent that, but it's still, he's very, very modest, very circumspect. He'd rather sit, and he's not an introvert by any means. He's very social, a lot of fun. But he doesn't want the limelight. Someone made a joke. I've got one of the new books is called Dear Shareholder. It's a collection of letters of CEOs that have attracted a high density of quality shareholders.
Sure.
And so I've got, Warren's the dean of that, obviously. Mark Leonard's in there. Prem Watsa is in there, another Canadian investor at Fairfax Financial Holdings. And I named the book Dear Shareholders, the best CEO letters from Warren Buffett to Prem Watsa. And a lot of people said, well, Mark is by far a better, a better track record than Prem. Why didn't you put Mark on there? I said, Mark would kill me. Mark doesn't want his name. Prem on the other, Prem's a little more like Warren. And I love Prem too. He's very happy to have his name.
Yeah.
So Mark he does not want the limelight. Is not interested in it at all. And I'd say that's the biggest difference. Another obvious difference is just in terms of their investment scope. Warren has invested throughout industry across every sector, really. Including tech now, and now Japan, Germany, elsewhere. Mark has been invested all over the world, but almost entirely in vertical market software. Software companies. He'd be good going beyond that, but so far Constellation is exclusively vertical market software. And so what they do every day, how they think, what they have to think about is very different. The economic context, the microeconomic industrial structure of the Berkshire companies are all over the map, 40 or 50 of them. So, how you think about incentives and drivers of managers and stuff, even performance of the business is different. At Constellation, it's far more similar business to business, so that I don't think that says a ton about the individuals, but I think it might say a little.
Yeah, and I think for those of us who follow on the outside, and Constellations, I think, made over 300 acquisitions throughout their time, so they've been even more acquisitive than Berkshire Hathaway has. That I think the skills that Mark Leonard and team bring to the table will allow them to kind of go outside of that vertical market software area. But they've done so well in that they probably don't want to step out because the economics don't look as attractive other places. So that's great, and we could talk about Constellation for a long time. Wonderful business. I want to ask one more, and this is about kind of ESG, the environmental, social, and governance. You've kind of been on the forefront of the governance part of the ESG movement before it was kind of a movement, I would say. This year has had a staggering amount of a kind of uprise, certainly associated with racism, throughout our country. And I know, in the early days, Warren Buffett was involved with his first wife, Susie, on a lot of the Martin Luther King things, and racial equality, and even gender equality, and we can add that. My question for you is, not as a board member of a public company, but also somebody who's a scholar of Berkshire Hathaway and has done all that, what can companies out there do? The NBA players have certainly taken a stand on this and raised awareness of it. But, for instance, you mentioned, I've been at the Berkshire meeting just a couple of years ago with my son. We walked around, 40,000 people there. I didn't see a whole lot of people of color in the audience. There were certainly a lot more Asians that were there than the previous time that I went before that. But just, you mentioned online, putting the annual letters on there. How do we get the greatness of capitalism in companies out there and make it more approachable for people of color?
Yeah, these are profound questions. And I think some of it does have to start locally and individually. I think the upheaval has stimulated a lot of that kind of ground up individual human beings asking themselves what they could do, and then specific communities, churches, schools. My own university has made a significant public commitment to focusing on inclusion, boards of directors, companies, more broadly, organizations like the Business Roundtable, let's say. And so I think you're seeing a heightened consciousness around this need. And I mean, I've done a little bit of it in terms of identifying, especially younger women in particular of color, and trying to get them into my networks of mostly older, whiter guys who have the keys to the boardroom door. And then I think you'll see a lot more of that. And then as a policy matter or as an intellectual matter, I recently did a lot of research on board gender diversity, and I was focused on this in part as the director of Constellation. So I was looking in particular at Canada, and as I did a ton of research, and I've just published an article based on the research in the Canadian Business Law Journal, which is a publication at the University of Toronto, focused on gender diversity with a somewhat North American bias and kind of a focus on Canada. What I found in the literature was both the academic literature and the sort of public advocacy literature were two big arguments for increased board gender diversity. And one of them was a social justice, fairness. It's the right thing to do. You can't exclude half the population from important functions like this. So we ought to just make that cultural change in the name of justice and doing right. And the other argument was an economic argument that said that diversification of boards is associated, and some people said causes, enhanced economic performance at companies. And there was a lot of rhetoric around that performance connection, and as I say, some assertions of causation. When I dug into literature, I found the arguments on the social justice aspect to be compelling. The economic argument, the evidence didn't support many of the claims. And so I came away from this concluding that it's a bad idea for advocates of board gender diversity. And I think this is my hypothesis. This discussion would apply also to minority diversity and beyond boards. It's not a great idea to make economic arguments that we will be richer if we do this, or we will have higher returns on invested capital, or this company will be a better performer. I can see why people made those arguments, but they've got rhetorical punch that they can persuade directors who feel like they owe it to the shareholder to deliver high returns to try to get them to agree. But since the data doesn't support it, I worry that when we appoint a more diverse board and the returns don't bear out, that group's going to be stigmatized. And I think that's the worst thing that could happen. So I think the social justice argument is compelling, and I'd elevate it. And I'd say, look, the economics, I'll bet there's going to be a random distribution. Every individual is a little stronger or weaker around, convincing their colleagues that this is a good or bad acquisition and so on. So leave that to the side and say it's correct. It's right.
Yeah. Yeah, that's good. I agree. Yeah.
So I've got a couple closing questions. First off, on the ESG question, you mentioned you serve on multiple boards or vice chairman at Constellation, study this area. How do you think that there's this conversation around the move to stakeholder capitalism? You mentioned the Business Roundtable. How do you think corporate governance truly is different, say, 10 years from now versus a lot of these conversations we're having? How much do you think is implemented, and what do you think are the changes that we could expect?
I think that my concern is that just as I said a minute ago about the rhetoric of economic outperformance, I'm a little concerned about the rhetoric of a new capitalism or stakeholder capitalism or a new hierarchy and which constituents count. and my focal point for that concern is the Business Roundtable's mission statement signed last August by 180 or so CEOs of major companies. They identified a list of priorities in corporate administration, and what's striking about the list is that it's shareholders at the bottom. That starts with employees and then includes customers, communities, and shareholders are at the bottom. And there's a lot of news made around how this is a new approach to capitalism. It's not shareholder capitalism, it's stakeholder capitalism. What bothered me about that is that there's actually nothing new in the statement. And I think it's misleading to describe it as this new thing. The statement is almost a carbon copy of the 1943 credo adopted by Johnson & Johnson, which is one of the most shareholder capitalist companies in the world. But what they said in 1943 and what they still say now is that the reason we're in business is to provide excellent products for customers, for doctors and patients. And then it's to build a workforce and train people and provide a livelihood, and to protect our communities, and finally to deliver a return to shareholders. And I just think that's how it's always been, that in a company earns profit for its shareholders by catering to its customers and rewarding its employees. And I think a thoroughgoing embrace of that is fair and fine. And I worry that what the Business Roundtable did was a little more political than real, and that it doesn't add value to the conversation or progress in governance, but it's either a bit of a whitewash or a bit of a dodge or a bit of a leave us alone. And so that's my concern around it. And how different and so on it looks. I mean, I think the question of race and gender is I think the highest priority, and maybe that's in the social sector. The bit about the environmental, I mean, that's a serious concern. My overall critique of the ESG movement is that we have had the engagements of this sort throughout American economic history under different labels. Before ESG, it was corporate social responsibility. Before that, the stakeholder model, and there's a lot of history to this endless, and I think it's an endless tension about how much emphasis ought to be put on the bottom line and shareholder returns versus those intermediate lines in terms of revenues and labor costs. And I think we have to continue to have those conversations. But I guess my big concern is how the current dialogue is dominated by index investors whose business model is such that they can really only speak to very high level general propositions. And I think because they own 4,000 companies, and so they can't really take an informed position about whether a Constellation, the chairman and the CEO ought to be different people, or whether at Berkshire there are too many friends and family of Warren Buffett's. They can't do that. So they end up saying all chairs and CEOs need to be split, or you need an independent outside. All boards need to be a majority of independent. And I worry about that as in corporate governance. I worry about it even more in environmental, maybe even in social, where it's just easier for BlackRock, Larry Fink, to say, here's how all companies need to be, because he can't afford to go in and look individually. So that's my greatest concern, is that the indexers, I mean, the business model is wonderful in a way. Let's deliver the market for ordinary people at virtually no cost or risk. But then when they inject themselves in environmental, social governance and other things, they can only do it wholesale. And it concerns me. That's one of the motivations for the Quality Shareholder Project too, because I think that cohort has better incentives to make tailored recommendations around certainly governance, and I think it's also true on the social and environmental side.
Yeah, it kind of just to conclude us, I had a couple last questions on Warren Buffett. We're at a time now. It seems like every 20 years we get this idea that value investing is dead, and that Warren Buffett has lost it, and all that. Where would you put the current narrative around Buffett as compared to where these discussions have been in the past?
I think you're exactly right. You see this cyclicality, and Warren's one of a kind, and he becomes a great target for criticism, and so he's contrarian, and people criticize him like to sort of follow the lead and be contrarian too. And he's still so he's iconic and nearly sui generis. He's in a class by himself. And even the people who have accepted or share the intellectual outlook, long-term committed shareholders, are a very small portion of the total population. I'd say my estimate, based on the research, is that they represent about 15% of ownership of equity capital, the quality shareholders do. 40% is by indexers, 40% is by transient, and 5% or so in varying combinations is held by activists. So it's a rare and lonely community. It's a small and kind of lonely community. I mean, on the other hand, there's a lot of collegiality, and there's a thick ecosystem, and people know each other and tend to see each other. And that's part of the reason why Motley Fool has been so successful. But we weather the storms, and so that whole cohort. Well, in 1999 you failed here. 2008 you failed here. 2020 you failed here. And the research. I mean, I think this is very interesting. The research on can value systematically outperform versus indexing is vibrant. We've seen it endlessly. I think it's inconclusive. Others draw stronger conclusions about what they've seen in the evidence. But to be sure, the relative delta varies over time, and of late, I guess the value crowd lags. Partly because the FANGs have just been so kind of phenomenal. But where we are, I think with views of Warren or views of the school he represents do go in a bit of an ebb and flow, at least externally. I mean, I think the people readers of my books, let's say, they tend to be steady believers and practitioners, throughout the 25 or so years that I've been doing it.
Yeah,
right. And that brings me to my last question. Obviously, attitudes throughout Warren Buffett's career of whether he's got it right or wrong have fluctuated, but he's 90 years old. We're looking now back more at his career more than we're looking towards the future. 20, 30 years from now, what do you think is the lasting legacy of Warren Buffett for investors?
To me, we started out the conversation identifying 4 possible answers to that question: investment prowess, management prowess, philanthropic generosity, or educator. I'd add a 5th, and I think that his greatest achievement, the thing for which he'll be most greatly remembered, is building a company that was bigger than himself. Again, I'm very bullish on Berkshire Hathaway. I think it'll be here in 30 years. I may be wrong, but I think that certainly he deserves credit for that. He poured his ego into Berkshire Hathaway. His cultural fingerprints are all over it, in terms of modesty, decentralization, thrift, permanence. He's designed it, and it's in his image. And yet, 400,000 employees, 800 subsidiaries, $500 billion of assets. This diverse, massive organization gets all that and is so big and powerful, and I think magnetic, that it'll last longer than him. So it's partly a prediction, partly a hope, because I think it's magnificent that he was able. I mean, this company is so distinctive and so special and so just absolutely unusual in corporate America, that I hope it continues, and I think it will, and I think if it does, that'd be his lasting legacy.
All right. Well, Lawrence, thanks you so much for taking the time to sit with us. If folks want to go find your books, keep track with what you're doing, where can they go find your work?
I guess the best place is my school, George Washington University. If you put in my name in that, you'll get my bio and links to. I'm running an initiative on the Quality Shareholder Program. You'll get links to a lot of the literature around that, and I've got obviously lots of books for sale on Amazon, and lots of my articles are free on the SSRN. But so I think just Googling my name will yield plenty of avenues.
Great. Well, thank you very much. We appreciate it, Larry. It was great catching up again. We appreciate all your insights on Berkshire Hathaway and social governance and all that kind of stuff. Have a wonderful rest of your summer and a great school year, whether it be virtual or whatever else. And hopefully we'll see you at a Berkshire Hathaway annual meeting in the near future in person.
Always a pleasure. Thank you both very much.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Steve Broido for mixing the show. For Buck Hartzell and Lawrence Cunningham, I'm Nick Sciple. Thanks for listening, and Fool on.